Hello and welcome everybody. So everybody's just streaming in, but we do have a hard stop on the hour. So I'm going to crack straight on. This is an unusual one for me because this is a webinar all about leverage buyouts. Now, if anybody's followed my content, you'll know that I'm actually a little bit kind of anti leverage buyouts. Well, not necessarily anti them, but I don't do them myself at all. Which is why I've brought along Paul Seabridge. Paul Seabridge is a member of the Harbour Club community, and there are quite a number of people inside the Harbour Club community that do use the leverage buyout strategy. And if you do leverage buyouts, it does open up a lot more opportunities. So there are, there's a lot of businesses you can buy using any of the kind of other 14 techniques we talk about in the Harbour Club. But leverage buyout does open up a new audience. It opens up another sort of raft of companies that you can potentially acquire. But I think there's a lot of mistakes that people make when they're doing leverage buyouts. And so I think it's important to understand the risks and the opportunities and how to do them in the right way. One of the risks that I always see is that effectively, I guess boiling back to square one, what is a leverage buyout? Well, leverage buyout is buying a company using debt, and that debt is secured against the company that you're buying. So it's a little bit like taking out a mortgage to buy a house. You can't buy the house in cash, you haven't got enough. So you use some of the equity in the house, the value in the house to buy the house, and that's the mortgage. Well, an LBO is very similar. You're borrowing money against the assets of the business, and you're using that money to buy out the owner of the business. Now, this comes with a few challenges. So the first challenge is that businesses are what I would classify as being a volatile asset class. So, the value of them can change quite dramatically in a very short space of time. You can have a global financial crisis, you can have a pandemic, you can have key employees leaving the company, you can have a key supplier or key customer fail, and suddenly the dynamics of that business changes dramatically and in an instant. And so having leverage, which you have to pay back, attached to a business which has that volatility attached to it, can just be a sort of high risk strategy from that perspective. The other thing is that we focus almost exclusively on owner managed businesses. So these tend to be businesses where the directors of the company also happen to be the owners of the company. And the challenge you have there is how interwoven they are into the day-to-day operations of the business. Now, all entrepreneurs say they're going to sell the business and they're going to stick around for 12 to 18 months to help hand over until you give them a few million quid. And then trust me, their passion and excitement for sticking around changes pretty much overnight. And so what I often say is when you do a leverage buyout, you're effectively taking your forward cash flow for quite some time. So, often these are 5-year loans or 7-year loans that you're attaching to the business. So you're effectively sacrificing future cash flow for 5 or even 7 years in advance. And then you're giving it to your star employee, the person that basically the whole business is hung around. You're giving it to your star employee so they can leave. And that can be quite a toxic, almost perfect storm of shit that you bring on that business when you do that. So I think the really big mistakes that I see people making with LBOs is that's the first one, is decapitating the business and then finding themselves in the driving seat with a whole bunch of debt that they've got to clear up. And then the other one is the type of debt that they leverage the business with. So there are types of debt that are very easy to get. So the most common go-to that people use are things like invoice finance, which is borrowing against the debtors in the company. The challenges with that is it can be quite expensive. The invoice finance companies have a horrible habit of pulling the plug on the business if times get tricky. And also it really is your future cash flow. It's the people that are about to pay you for the goods and services that you sold them that you're kind of taking out of the business to go and buy the other party. So you have to be very careful about how you structure a deal using leverage, so that leverage is a small component of the transaction rather than the entire transaction. So, we often see people look at the balance sheet of a company, figure out how much they can borrow, and then go and borrow all of that and hand it straight to the previous owner in one go. And that obviously leaves you in a very over leveraged position. It leaves the previous owner scot-free to run away and go and do something else, and yeah, often gets yourself in a pickle. But as we have Paul with us, and he really is doing these deals on an almost monthly basis, pretty much one a month, wasn't it, Paul, last year?
Yeah, so I was just totting up actually. We've done 4 deals so far this year, and 3 of them are leveraged
Wow.
buyouts. So yeah.
Okay, yeah. So there we have it. So yeah, what walk us through what your approach is when you're going into an LBO situation. What do you look for, and how do you de-risk?
So I think the first thing that we want to make sure is that actually when we're sourcing opportunities is that we're going directly to the business owner. I think, a lot of people that are in M&A, they'll go to brokers, they'll look for deals that way. But the challenge with brokers is always that they overvalue the business. They have this thing called adjusted EBIT, which is basically them making up a number to say how profitable the business is. But actually, when you delve into the detail, you find out that it's nowhere near that figure. And pretty much any leverage buyout is based on whatever the accounts are today, not what they might be in the future. So the first thing that we're doing is making sure that we're sourcing deals directly. So for people that have been on the Harbour Club or might look to come on the Harbour Club, Jeremy obviously teaches you how to do that. But we connect directly with business owners. So our key target is cash rich businesses, asset rich businesses, where there's no more than 3 shareholders, so that we've got a reasonable chance of getting a deal over the line. There's only a few people to influence, and then we're looking at the financials to see whether or not we can leverage it. So when we have the discussions with the business owner, we're telling them how we would normally fund it. So we'll explain that we're going to borrow, and we explain the reasons why we do it that way, and then we look at the assets, and I guess, just to sort of pick up on a point that you've made there, Jeremy, I think one of the first ever deals I did prior to actually coming on the Harbour Club was a leverage buyout, and we over leveraged the business, and it almost went bump. So first rule is, let's not over leverage these things. It's dead easy to look at a balance sheet and say, well, look, it's got all these assets, we can borrow all of this money, and then we can do the deal. But typically, we don't normally use more than 50% of the balance sheet at 50% of the available cash flow. So effectively, if we do the deal and then for some reason a COVID pandemic comes along, or something else like potentially World War III comes along, you've got somewhere to go. That, look, if profits dive, if you're not as good at running the business as a business owner, you're not using all of your available cash flow to fund a transaction. So really, that's sort of the, obviously not in mega detail, but that's the sort of approach that we take. And then it's really I think a sales and marketing exercise of getting the business owner to like you, to trust that you're going to be a safe pair of hands, you're going to run this business, and just because there's a load of new debt coming into the business, it's still affordable, and it gives them their exit.
Yeah, fantastic. And what could you run us through an example and the type of debt that you used, perhaps in one of the more recent deals that you've done?
Yeah, so last year we bought a fresh produce business, so about 50 million turnover, 2 million profit, so pretty decent sized business. And with that particular transaction, we just used invoice finance. So we leveraged the receivables, that gave us an amount. This is a UK based business, so they also had quite a lot of surplus cash on the balance sheet, and it was more tax efficient for us to include that cash in the sale and for them to extract it as the initial payment together with the debt that we introduced. So that gave them a down payment, and then the balance of the business is being paid off over 4 years in annual installments, and I think we're paying a 2 or 3% interest on that, on that deferred consideration. And overall, I think we've paid 2.2 times multiple for that business. So a lot of people think, oh, when you're doing leverage buyouts, you're paying 5-8 times multiple. We never pay more than 3, and their reason for exiting was they wanted to retire. 6 shareholders, they wanted to retire. So
yeah, that you make a really good point there about valuations, because I guess that's another way people over leverage, is they overpay. If somebody's going to do a leverage buyout, then it does mean they're going to get a proportion of cash up front. And so if they're getting a proportion of cash up front, then the valuation has to be right. And if you think about it, paying 3 times earnings means that you recover the investment that you made in within about 3 years. Now, you might think that sounds great, but actually you can invest in a diversified portfolio and in with a bank and probably get 15 to 20% return. So you really do want a much bigger return if you're going to take the risk of being in a small business. So that sort of multiple is fair and justifiable. And in fact, if you look at what deals actually close for, so bizbuysell.com do a report. You can just type bizbuysell.com report into Google and you can download it. It's an annual report and it shows you by industry the multiples that companies are actually selling for, and it's dramatically less than you might think if you've only ever read brokers' offers. And of course, brokers are multiplying by 6 to 8 times, but the number that they're multiplying by 6 to 8 times is also a fabricated number. So they're manipulating it at both ends, and that's why they don't sell many businesses. So they tend to kind of screw it up that way. And so in that particular one, in the fresh produce one, you used the element of debt plus the cash at the bank. Was there any other part of that structure, any deferred payments or earnouts or anything, or was it just a pretty vanilla?
Yeah, so the overall purchase, we basically, the cash added to the leverages that we got from the debtor finance gave us around about a 50% of the purchase price in initial consideration, and then the balance is being paid off over 4 years. And that balance is no more than 50% of the available cash flow. So it's more than affordable for the business. I mean, with that particular company, I think we've increased the profits by about 700 grand. So it's actually going really well. And we probably, if we wanted to, be able to pay off the debt a lot quicker. But yeah, if it had gone the other way, we would still be able to afford that. So in that particular example, yeah, we've only used one source of asset to leverage. Looking at some of the deals that we've done this year, there was one where there was a real estate, they own the commercial premises that they operated from. We borrowed 50% of its value. We also did the invoice finance. And then they had some surplus cash, and we managed to put it together that way. So I guess the key is to try and make sure you don't go after every single asset, because then you end up over leveraging yourself. And it's always better to leave something behind just in case if something goes wrong in the future. But I think invoice finance is always the easiest one for me. If you're going to go down a whole leveraging a property, that you're going to have to get property lawyers involved. They're going to want to do their conveyancing. They're going to want to make sure everything's all fine with the property title, and that takes a long time. If it's a clean debtor book, you can usually get a facility in place within 3 or 4 weeks. So it's pretty easy to get and get installed into a business. So that's always the first place that we look. Or maybe if they've got some meaty plant and machinery, that's fairly straightforward to get finance against. But again, you have to go down the whole line of the lender will want to come in and value that plant and machinery and make sure that it is worth what we're saying it's worth. So
so what have you ever played around with the government-backed loan schemes like the SBA in the US, or the British Business Bank in the UK, or there's an equivalent in Australia as well, I believe?
Yeah, so one of the deals that we've done this year is using one of these RLS loans. So last year it was the bounce back loans and the CBILS loans in the UK. This UK deal now, they're now called a recovery loan, the recovery loan scheme, so RLS loans. So you can borrow up to 250 grand PG free, and you can borrow up to 3 of those loans. So you could basically take 3 loans out for 250 each, so 750, and you can use that to fund then the deal. There's 2 ways to do it. One, you can get the seller to basically apply for that finance beforehand. So they raise the funds and then you do the deal, and then that cash can be used to facilitate the transaction. Or you can apply as an incoming buyer. It's more difficult to do it that way. There's more caveats, but both ways are possible, and they're fairly straightforward to get. If you can show that COVID had an impact on your business, doesn't have to necessarily mean that the profits have gone down. It could be that you had the staff on furlough or other things. As long as you can demonstrate that to the lender, then you can use these funds to facilitate a transaction. Yeah, like that, and they take about 14 days to get in place. So really straightforward.
Yeah, fantastic. And with most of those, the lenders do, it follows pretty much standard bank lending criteria in that you should have some skin in the game. So they normally like you to have, is it 10 or 20% exposure in the transaction?
So if you're doing it buy side, so yeah, they would expect you to be putting some money in yourself. So normally it's about 10%. If you're doing it sell side, so if the seller's going to organize all of the funding before you actually do the deal, then there's no requirement to put any equity in. In the US, I've not personally done an SBA deal because you need to have a US resident with a green card that's going to run the business, and you have to put equity into those, which is 10%. So if someone's got 250 grand knocking around, they might be able to get an SBA loan of 2.5 million to be able to do the deal. But
yeah, although we found a really cool hack for SBA loans, actually, which I'll just share with everybody. So effectively what you do is you take a stake in the business, a 10 or 20% stake in the business in exchange for adding value to the company. Now, what you tend to find when you come across a business, particularly in the US, businesses aren't run to demonstrate their profit, they're run to mitigate as much tax as possible. So what you tend to find is that companies' accounts aren't really at a stage that makes them very financeable or even makes the whole business sellable. They're sweeping so much stuff under the carpet and hiding all sorts of personal expenses in there that it's almost impossible for them to go and sell the business. So typically what you can do is take a 10% stake in the business in order to make it sellable. So you go through and you clean up the accounts and the processes and the systems so that so it becomes a sellable business. And then you approach the FBA to do a management buyout. And as a management buyout, you can get 100% financing because you're already, as long as your stake is more than 10%, and typically getting 10 or 20% under those circumstances is relatively straightforward if you're adding value. You can then use the SBA to buy out the balance of the business. But again, I caveat that with all the same things. Don't just raise 4 million and throw it at the previous owner. If he wants 4 million, maybe he's going to get 1 million of it first or 1.5 million up front, and then there's going to be some staged payments or whatever. The other great thing with SBA is as soon as you've paid it off, you can go back for more. So you can get as many SBA loans in your lifetime as you can, all you can eat, basically. So there is this wonderful opportunity to be able to recycle that facility and go again and again and again. So if you buy good cash generative businesses where you can extinguish that debt in a shorter time frame than the loan is taken out, you can effectively go back and get some more. So and I'm pretty sure that structure would work in the UK as well, although I don't have any case studies of people trying it.
Yeah, no, I definitely see no reason why that couldn't work in the UK as well.
Yeah. So 50 million revenue and a couple of million or 2.5 million of profit was that business. Is that the kind of upper end of the deals you can do using this method? And then what's the kind of smallest deal that you would tend to look at for LBO?
Yeah, so that's the biggest deal I've ever done in terms of revenue size. I guess the sweet spot is sort of between that 5 and 20 million turnover level. That's sort of the typical range that we look at. They're big enough to be maybe not as reliant on the business owner because, a £5 million business, the business owner probably isn't doing everything themselves. They've probably got a capable management team that's running various parts of the business, so it makes it less risky from our perspective. And up to 25 million, it's fairly straightforward to organize these structures. Over and above the 25 million, then you're probably playing with bigger businesses that probably will expect a larger multiple to sell for, and unless you're prepared to get into an over leveraged position, it's usually very difficult to do anything over and above that. That being said, when you do acquire one of these businesses, so like the fresh produce business, we're using that as a platform business to roll up in this sector. So the idea is that we'll use the additional borrowing power that business has to potentially facilitate other deals that we might want to do. I think if you go under the 5 million level, then it's not to say it's not possible, but it's you're probably going to find that the business owner is quite involved in the day-to-day running of the business, so it's quite a big risk, particularly if they're wanting to exit. And I think the other challenge is really about, it is quite expensive. You're asking a bank to front the money rather than you putting any money in yourself. So it's not uncommon to see potentially double-digit interest rates. Some of these RLS loans, you're talking 10-11%. That's quite expensive. So you've got to be able to not just afford it, but it's actually got to make sense for you. And it's so costly to put these together that you might as well play in a bigger business than do it in a small one where you can end up owning the business, but if you've got to pay for it for 4 years and you're not going to earn a great deal of money out of it, if you've got probably 100 grand's worth of fees and broker fees and financier fees and interest payments, etc., to fund.
Yeah. Now, the big thing that always comes up with LBOs is personal guarantees. So where do you sit with regards to personal guarantees and leverage buyouts?
Don't sign them. And we, I mean, I guess we've built a track record with a number of lenders, so they know us, so that I guess they're more comfortable. I think if you were doing one from scratch, I think it would be quite difficult to find a lender that would be prepared to do this without a PG. That being said, in the UK, you can insure PGs. There's a company called Purbeck Insurance. You can insure between 60 and 80% of the personal guarantee. Having looked at it and had experience of it, I would say, to be honest, it's not worth the paper it's written on, because whilst you can insure it effectively, the company's got to go into insolvency, and you've got to use their insolvency practitioners, and you've got to follow all of their processes for them to, pay out on that PG. So, if you weren't willing to let a business go under, but you were going to, struggle with the cash flow, you're never going to call in that insurance unless the business actually goes bump. And even then, I mean, it's a bit like any sort of insurance. The insurers never want to pay out on your claim, and there's a lot of hoops to jump through. So we've just taken the personal sort of decision not to sign them, and then we don't have that issue.
Yeah. No, I think that's very, very wise. I've heard personal guarantees once or guarantors being described as a dickhead with a pen, which is a little bit harsh because there's so many things now that you do have to guarantee, from leases to credit card machines to all sorts of things. But yeah, borrowing money, investing it in a volatile asset, and then personally guaranteeing it is a really toxic mix, particularly when you can have geopolitical or macro economic events happen in the world that you have no control over, that could then mean that you're personally liable for all of that stuff. It's kind of like taking your entire net worth and sticking it on the roulette table every time you sign one of those agreements, which is probably not a wise thing to do. So I think I think LBOs in 2022 are a little bit different from other times in history, because there are a lot of these COVID recovery loans, and there is an appetite from lenders to lend money. Interest rates are still relatively low, but as you point out, when you do unsecured or unpersonally guaranteed debt, it does tend to push the interest rates up a little bit, and that's the kind of the trade-off. Now, we do have a lender inside the Harbour Club app who has 30 different kinds of unsecured debt, which can help people structure deals. And whilst there's a whole bunch we've talked about on here and that we've discussed before, they do have some really innovative types of debt that I'd never come across before until meeting him. And a couple of them I'll give you a taster of. One of them is purchase order finance. So, typically when you're trying to raise money for a company, you'll run through the assets on the balance sheet, and pretty much everything that sits on the asset side is leverageable by someone. But a purchase order doesn't appear anywhere in the accounts, and a purchase order is just an order to purchase goods from a company. And if that purchase order is from a large organization or a government, you've got big customers, you're supplying, large corporates or governments, then those purchase orders are leverageable. And we actually had a transaction where the company was only doing 600,000 a year in revenue, so well below what we would normally look for as a target. But they had a 1.6 million euro purchase order from the HSI, which HSE, I can't remember what it is. It's the NHS in Ireland, basically, so the health service in Ireland. And so they had this 1.6 million purchase order. We went to this financing company, and basically they said that because it was a sovereign guarantee, it was a government order, they could leverage 100% of that purchase order. So in fact, for that company, we were able to get 1.6 million against a 1.6 million purchase order. The cost of the goods that they were buying to support that order was about 600 grand. So they were able to buy the 600 grand's worth of goods and ship them from China to Ireland, and still have 1 million of cash left over from that facility. So that can be hugely powerful when you're doing an acquisition, because that's, that million is probably more than the whole business is worth. So you've got lots of legroom in there. The other one that he uses is one called royalty finance. Now, Paul, have you ever used royalty finance?
I haven't, but I have looked at it as a potential way to do deals. I think it's an expensive tool, but it's
Yeah.
it is something that is in our toolkit. We've never had a deal that we've not been able to use maybe the more traditional forms of leverage, but it's certainly an interesting one.
Yeah, so it basically it tends to be a multiple of your EBIT that they lend you, which is very different to normal lending facilities, which are predicated on your assets or on net asset value on the balance sheet and things like that. And typically they'll give you around 3 times your EBIT, but the minimum needs to be around about 6 million. So sorry, the EBIT needs to be about 2 million to give you a 6 million facility. So if you've got a company that's doing 2 million of EBIT, you can borrow this 6 million against it. And typically it's very long term, like 25, 30-year term, and it's a repayment model. So you're repaying month on month over the 30 years. So it's like having a mortgage basically. But and the interest rate is quite high. So, you're often early double digits, 10, 11%, that sort of level. So for anybody that's ever looked at how much you pay back on your mortgage when you've got a 3% interest rate, you're typically paying back double what you borrowed over the 25 years. So you can imagine what you end up paying back over the total lifespan of a royalty finance transaction. But it is unsecured, so you can still access other forms of finance whilst having royalty finance in place. It doesn't have a personal guarantee attached to it, so it's a bit of a balls out sort of strategy. And obviously, if you can use that cash to buy assets that massively outperform the cost of capital, so if the acquisition you're doing is got that 33% return that we were talking about, and you're borrowing your money at 11%, then there is a rationale there for using that kind of finance, and particularly for doing roll-ups and things like that. I could see how the appeal of using a facility like that to consolidate a particular industry could be quite an exciting way to do it. So I think there's some good opportunities to use those kind of slightly more creative structures. So I think everyone that's here is here because they understand what the Harbour Club is. Paul joined the Harbour. God, when did you join the Harbour Club? It's
2017 it was, yeah.
2017, yeah, bloody hell, time really does fly, doesn't it? So back in 2017, I was still doing them over in Mallorca in my house in the Balearic Islands. Paul came and sat in my house and listened to me waffle on about deals for 3 days. But the Harbour Club is a fantastic community now. There's about 2,000 people all over the world, from Australia right the way through to the west coast of the US and everywhere in between. There's a real concentration of membership in the English-speaking countries. So in US, Canada, UK, Australia, New Zealand, Singapore. There's a higher density of members, but we do have members in all sorts of places. All over the world, and we're very, very active doing deals. In 2020, we buy and sell companies on a daily basis, but in 2020, 34 people generated $78 million in exit. So that was people in the Harbour Club community selling businesses. They created 78 million of wealth. We have our own app where people can share deals, put questions in there, get kind of coaching and support around the transactions they're doing, or find joint venture partners in far-flung places. We have a lot of inside the community education. Paul, in fact, has done several videos that have been shared with the community around how to interpret balance sheets, how to source transactions. We have many other members that have also contributed in that way. It's a really fantastic community, and it really does help people accelerate their goals, to learn about how to buy owner-managed businesses, to learn how to do deals without committing your own capital up front. And whilst LBOs are not a core component of our deal, we have a very sort of rich and sharing environment around doing LBOs. In fact, I did a video a couple of years ago now that we've never really done anything with, and it's with a very big LBO player. In fact, he's done over $50 billion worth of LBO transactions, and he did a training course for our members, which, like I say, we've not really done anything with. But what we're going to do is anyone who joins the Harbour Club community between now and midnight on March the 9th. So it's a very, very limited offer. So anyone that joins the Harbour Club and gets all the benefits of the Harbour Club, by March the 9th at midnight UK time, we're going to throw this course in with the mix. So you'll be able to learn how this person who's done $50 billion of leverage buyouts, how they find deals, how they identify them, the spreadsheet and structure they use for calculating how much they should pay for them, how they close the deal, how they access the finance, how they protect themselves from potential downside, and a whole bunch of other stuff is included in that presentation. So yeah, if I'm sure you've all seen the value that you get from being in the Harbour Club community anyway. Our training is completely different to anything else that's out there on the market. We are the only genuine kind of M&A program that's not just trying to sell you more and more shit. So there is no upsell, there's no mentoring or other things that you have to buy. It's a one-off membership. You're then in the community for life, and it's a really sharing and vibrant community. And you'll get huge amounts of value from it, and it will really help accelerate your goals towards doing deals and creating wealth. Somebody here saying they can't travel. Don't worry, it's the course is online. We do have physical meetups as well, but the main content is delivered online, and then the app is obviously, it's an app, so you can use it from your phone or on your computer and access stuff. So please do reach out to John or Monty or whoever you've been talking to at the Harbour Club, and grab yourself the opportunity to sign up before the 9th at 11:59. And we'll get there. Now we're going to dive into some questions. So we've got about half an hour left of the thing. I do see people have been chucking questions in the chat. I think also people have been putting links and various other things that you can click on. But I'm going to go to the Q&A section to answer the questions there, and let's see how many we can get through before we hit the hours limit. And if there's any time left over, I'll dive into whatever's in the chat section. So. If looking at doing deals without wanting to get involved with interest, is it possible to do deals? Would the £1 deal be the only option to do deals if didn't want to leverage due to the interest element? That sounds like a halal question to me, or possibly a kosher question, but yes, of course it is. Yeah, so of all the deal structures that we talk about in the Harbour Club, there's 15 different deal structures you can use. LBOs is just one of them, and all of the other types of transaction enable you to buy and sell companies without using debt and without using cash up front. So the whole concept of the Harbour Club was coming up with more and more creative ways of doing deals, basically. And when we first started the Harbour Club, there were about 6 of them, and then we just keep evolving and changing and adapting and adding new, more and more creative ways of getting these deals done. So yeah, there's many ways that you can do a deal. Look, we just did a transaction that was my biggest in my history. It was 220 million euros for a hydrogen battery solar business. It's a Paris company listed on the Paris Stock Exchange, in fact. And that was a no money down transaction. So there is very big deals that can be done without using cash up front. You just need to understand how to do them. Can you share the name of the report? Yeah, it was the bizbuysell.com report. Bizbuysell.com is actually a US website for buying and selling businesses. So it's BIZ, bizbuysell.com. Yeah, that report is on there. The only other report I mentioned was I may have mentioned, was the PKF report that we published, which was how our 34 members made $78 million in exit in 2020. Yeah. How do you avoid personal guarantees? Don't sign them. It's identifying the lenders that will do facilities without personal guarantees. I mean, as Paul said, when you have a relationship with lenders and you've done a few deals and you get some credibility with them, life does become much more easy. But we do have a broker in the Harbour Club that has 30 different forms of finance that you can use without personal guarantees. And they're also kind of unsecured lines of finance. So that works quite well. Paul, would you add anything else onto the personal guarantee point?
Yeah, don't sign them. But another good way of sort of avoiding them, particularly if you haven't done deals before, is build an advisory board. So if you go out and find amazing people from the industry that you want to get into, and offer them a percentage of the deal that you're going to do for them to effectively lend their credibility and name to the project, I guess will give lenders a lot more comfort that there's a really experienced incoming management team that know what they're doing because they've been there, done it, and worn the t-shirt. I found that quite useful when I started off doing these types of transactions.
That's a really good point, because when you bought that fresh produce company, you actually roped in another Harbour clubber, didn't you, who had
Yeah,
tons of experience in that
yeah,
whole fast-moving consumer goods and supermarket
yeah,
space, and their CV was kind of stellar
yeah, yeah.
in that arena, and I'm guessing that really helped with the lender.
Yeah, definitely. And the chairman of that business, he's got 40 years chairing public companies in the food space. So, and he's a doctor. So I don't think you can get much more qualified than that. So, yeah, definitely. Yeah, definitely helps with credibility for the lenders. And then they're less, if you're going to then put, if they say, I want a PG and you push back on it, that they're more likely to accept you pushing back on it if you can say, yeah, but we've got this really amazing team of people that know what they're doing. So your
Yeah,
risk
yeah.
is minimal.
And of course, within the Harbour Club community, you can just do a quick shout out and say who has experience in XYZ sector. And if it's not somebody immediately in the community, I'm sure somebody will know somebody that can bring that value to bear. So yeah, so the community really helps in that sort of respect. What was that business valuation platform website? That was the bizbuysell.com. Although talking about valuations, very interestingly, Harbour Club has its own valuation tool called Valatoa, where it's a software as a service kind of business where you type in all the details of the company. It not only spits out a valuation, but explains all the things that you would need to improve in order to increase that valuation. And I talked about taking that 10 or 20% stake and then doing a leverage buyout as a management buyout, so buying out the balance of the shares. That valuation tool can be really cool for closing those kind of deals, because you can show them where they are now, where they could get to, and why it would be valuable to have you on board, because you can help bridge that gap between where they are now and where they're going to. And like I say, that's a proprietary tool within the Harbour Club community that you can only get in the Harbour Club. How long would you have to be a stakeholder in the business to qualify for the SBA management buyout? Pretty much straight away. So as soon as you are a shareholder, you have skin in the game, and you can argue the management buyout. So yeah, as soon as you've created the value that gives you the shares, you can do it. So you can even be very transparent with the business owner and just say, look, I'm going to do a leverage buyout, but you need to give me some shares first to do it. I prefer the method of adding some value in exchange for some shares, because I think that also really helps with the relationship with the target. So one of the key things is building rapport and trust with the target. If you say you're going to do something and then you do it, and you get rewarded with shares for doing it, then you're automatically in the top kind of 1% of people in the world, because most people say they can do stuff and then never do. So actually delivering on your first promise to them is an awesome relationship builder. Would you add anything on that relationship side, Paul? Because I know you find that absolutely key to getting transactions done.
Yeah, I think for me, the whole process is about sales and marketing. So marketing is to find the deal, but then once you've found the deal, the sales bit is you've got to get the business owner to completely, fall in love with you metaphorically, because if they're going to trust, you taking over their business and looking after their staff and not changing the name of their business and all that sort of stuff, the money is almost, I think, secondary to as priorities. And I think that time you spend with them building that relationship gives you that trust. And when you've got the trust, then it's easy to start negotiating and bringing in creative structures and all those sorts of things.
Yeah, yeah. Do you have an example of an LBO for a SaaS business? SaaS businesses are very hard to buy in an LBO because they don't really have tangible assets that a lender could get their head around. You might find you could use something like that royalty finance option that I spoke about, because you would have revenue and profits. But like I say, that starts at about 2 million of profit per year. Now, 2 million of profit per year is a really big SaaS company. A lot of them tend to be 2 million revenue is a pretty big SaaS company, to be honest. So yeah, you would be in the, at that level, you would be, there would be private equity companies crawling all over you to buy a business that has 2 million of profit. In fact, probably the most famous roll up of SaaS companies is Constellation Software in Canada, and they've got like 300 or more acquisitions that they've done, and their average profit per acquisition is $1 million. So they clearly go after everything in that sort of range. So you'd have, really significant competition. We are actually in the process of trying to buy a SaaS business right now through one of our public companies, and we're using the agglomeration model to do that acquisition, which you can find out about online or on the Harbour Club. And basically, we're acquiring that using the stock in the public company. So again, it would be a no money down transaction where we issue the stock in the public company of the acquisition capital to buy that company. And it's a really interesting business as well, because the niche that they're in fits perfectly with a business that we already have in that public company. So the potential to then grow that business very, very quickly by simply cross-pollinating the clients is enormous. So it could be a really attractive acquisition for us. What is your approach when business is already using invoice finance, i.e. recruitment firms tend to use this facility and don't tend to have much in the way of assets? Paul, you're big in the recruitment space. What's
Yeah, so I guess you've got to, for a leverage buyout to work, there needs to be assets available that you can leverage against. So, if they've already got a certain level of debt, then potentially it doesn't work. Yet recruitment companies, they tend to typically, their only asset tends to be their receivables, because they're based in a serviced office and they don't own anything else. So, and because of the cash flow requirements in a recruitment business, it's very rare to find one that doesn't use invoice finance. That being said, I have done 2 deals in recruitment businesses that didn't have invoice finance, and we managed to buy both of them. So it is possible. If you use say in the UK, you can use a sourcing software called Endole, where you can actually search for companies that have got a debt ratio under a certain level. So normally when we're looking for target businesses, we're looking for companies that have got no more than 30% of their balance sheet already as debt, because then there's still 70% of the balance sheet untouched that you can use.
That's really good advice, actually. Yeah, use that as part of the search criteria. Yeah, I've always struggled to get my head around recruitment companies. They transact a lot. There's a lot of M&A activity in the recruitment space and a lot of roll-ups in the recruitment space, and yet the barrier to entry is almost zero. Every recruitment company is founded by somebody that left a recruitment company and took a load of clients with them. So it's there's always that risk that happens to you too, particularly when you cash out the owners and they go on to start their next recruitment company. And literally the value in the business walks out the door at 5 o'clock every day. There is no other intrinsic value to that business other than the salespeople in the business. Now, of course, there are niches and things like that where people have managed to really create moats and dominate a particular space, but it does have that kind of low barrier to entry risk aspect. But yeah, we've seen quite a few deals in that space go on in the Harbour Club community, and certainly big is beautiful. You can protect yourself against that attrition by staff leaving by being big enough that it doesn't hurt anymore. So can you recommend finance broker or partner that helps with LBOs? Yeah, we have one in the Harbour Club community who's very active helping people. Like I said, they've got over 30 different types of leverage that you can do that's unsecured and without PGs. Questionary PGs for invoice discounting. I'm told that funders want PGs in place to discourage fraud, and rarely these days agree to funding without PG in place. Do you do a fraud PG?
Yeah, so it's not called a PG, it's a director's warranty. So you're signing to basically say, I'm not going to be personal liable unless I do these things, and one of those things is basically fraud. So if you took all the money out of the bank and defrauded the business, then of course they're going to hold you personally liable. So it's not uncommon to sign director's warranties, but they're obviously different from PGs.
Yeah, the most common fraud you can do with invoice finance is raising invoices for stuff you haven't done yet or have no intention of doing, because basically within their platform you can post an invoice for 100 grand and they'll give you 70 grand 24 hours later. So there's a big temptation there for dodgy business people to do that. So yeah, you normally have to give them a protection that if you do that, you're liable for it. Where is the list for the 30 funding methods? Reach out in the app and make contact, and they'll go through that with you. Would you advise using corporate bonds or zero coupon bonds to finance LBO? Okay, so bonds are debt instruments that you issue in order to sell the debt instrument to get cash in that you then go and use for acquisitions. They were made super famous in the 70s and 80s by a guy called Michael Milken in the US. who basically kind of created what they called the junk bond movement. Junk is now called high yield because it's a bit more polite. But basically they are sort of, big bonds issued against small companies. Now, we explored using bonds as a way of raising capital for businesses, but the challenge that you have is that because of their popularity in the 80s, every man and his dog issued a bond. And so now when you go out and try and sell bonds, you're up against people like Apple and Microsoft and companies with great credit ratings that everybody's heard of. So when your John Smith Limited decides to issue a bond, it's not particularly attractive to anybody. The repercussions of that is that you end up having to pay quite high coupons, which is the interest payment that you make on the bond, in order to attract investors. And then you have to pay the distribution channel that actually goes out and sells the bond for you, quite a high commission to get them to prioritize selling your bond over selling Microsoft's bond, for example. And so those two things put together, the high interest and the high cost of distribution, basically means you end up with a fraction of the money that you have to repay. So you're repaying 100 grand, but you perhaps only got 40 or 50 that you can go and deploy. And that makes it very, very hard to make the deals stack up. So what we did in the Harbour Club community, we created something called an extra bond. And we were the first people I can track down anyway that have ever used this structure. And extra stands for Exchange Traded Acquisition Bond. And so effectively what we did is we created a bond and we listed it on the Frankfurt Stock Exchange and the Dublin Euronext Stock Exchange. And then we issue those bonds and actually use them as acquisition capital. So instead of raising money and giving them the money, we just give them the bond. Now, when we just give the business owner the bonds, they receive a listed bond that gets transferred into their bank account so they can see it there every day. They get a coupon of 5% per year over the 5-year term of the bond. And so then what you find is that you're competing with what else they would do with the money. So if we gave somebody 3 million quid, for example, what would they do with that 3 million? They might buy a certificate of deposit or put it into a savings account. Well, in those circumstances, they're getting 1% a year or less than 1% a year return. They could try and create some sort of income fund on the stock market, but again, dividends and things like that, dividends and bonds, they might only get 3 or 4% per year return. So by giving them 5% per year return, they're basically beating any other place that they could keep the money. So their 3 million of bonds is giving them 150 grand a year for 5 years. And then they get the 3 million capital at the end of it, which is the time it takes us to accumulate the cash to extinguish the bond from the operations of the business. To say that these have been quite successful would be a massive understatement. We've done a whole bunch of deals using these extra bonds, and they've been really well received as an instrument. I think we've probably done 40 million euros of transactions using extra bonds now in the 18 months since we launched the program. And for another company that we just took public in December, we're about to do a 200 million euro bond issue in order to go and do a bunch of acquisitions. It's a really cool solution. We go into it in quite a bit of detail in the Harbour Club and explain how to do it. And actually, Harbour Club members can list a bond for free, no money down, because they can partner up with my private equity company in Singapore, Unity, and we will do the bond listing, and you can pay us in bonds for actually doing it. So again, makes it a no money down option. Roughly how many members are there in England? Just a ballpark. I would say from the total membership, about half is UK, maybe even slightly more than half. So we were obviously in the UK first back in 2009 when the Harbour Club first started. We only actually launched in the US in probably about 2019. Or 2018, can't remember now. But so other countries have been more recently added. So there's lots of people to play with in the UK. What was the name of the financing firm in the Harbour Club? So they have some solutions that work in the US, but most of the financing solutions they are a UK broker, and they're in the Rolodex in the app. So just hit them up in there. What are the requirements for getting a royalty loan, i.e. 50% cash from the buyer unsecured? No, it's really just the size of the business that you start with. So, and in fact, the royalty finance is one of the international forms of finance. So your company can be in any kind of mature economy where they've got good corporate governance. So I know you're in Switzerland, because I recognize the name, you have the same name as my daughter. So I know you're in Switzerland. So yeah, Switzerland would be ideal for that kind of thing. They would certainly look at that. But yeah, pretty much it's all predicated on your size rather than the deal that or what you're going to go and do with the money, or the deal that you're going to go and execute. How can we access the LBO course if we're already in the Harbour Club? Yeah, have a chat with John about that. See what we can do. What about existing members? Do you still do your clubhouse room? No, I don't actually. Somebody actually invited me to a clubhouse room the other day, and I was like, "Fuck, does that still exist?" Really, it was one of those things that when there was lots of lockdowns and stuff, with everyone was sitting at home, it was kind of like business radio, wasn't it? You could just switch it on and listen to the conversations and dive in if you wanted to. But yeah, from my end, it kind of died off a bit. So no, I haven't logged into Clubhouse for ages now. So yeah, as usual, some great points. A quick question: how can you leverage non-tangible assets on the balance sheet, IP, software, code, etc.? The short answer is you can't. But what you can leverage is the invoices that you send to your customers for those things, and also you can use things like the royalty finance, purchase order finance, and those other things that sit in that way. Paul, would you add anything to that?
Yeah, you can do cash flow loans as well. So there are lenders out there that will do 3 to 4 times EBIT. Most of them will require an equity check off you of 5 to 10%, but you can be creative. So if a business owner was going to stick around, maybe you buy 90%, leave them with 10. There's your equity. So there's skin in the game. There's ways around actually having to physically not have to put the cash in. There are lenders out there, but they're quite difficult to get, and they're very clunky, and there's lots of covenants. And but it is a solution.
Yeah, fantastic. Questions keep moving up and down. I'm trying to focus on them. Can you talk about the strategies you use where you leverage the business for a part of the total sale, and the owner's concern is that they may end up with a business that's run into the ground and saddled with debt if you can't make the deferred payments? I guess that comes up quite a bit. Paul?
Pretty much every time. I think that's the biggest risk for the owner. Are they going to actually get paid? We never pay all of the money on closing, because we want them to have a vested interest to stick around to make sure there is an orderly handover, that the business continues and it continues to be successful. So it's really about trust and relationship and the people that you surround yourself with. So we'll bring experienced people from the industry to the deal table that will help get the deal over the line, so they can point to their successes, we can point to ours. And if the business owner is going to stick around for a year, well, if they're going to continue to run the business, or mainly run the business, well, if it's going to get messed up and that puts their deferred at risk, well, it's more on them rather than us. So and you can build various protections into the actual sale and purchase contract as well, about for as long as you owe the money, you won't do fundamental things like restructure, sell assets, pay big dividends, etc., etc. So there's lots of things you can do to sort of alleviate that risk, but it is a risk, and it really boils down to them trusting that you're not actually going to mess it up, and you are actually going to be able to pay them.
Yeah, and actually there's a really good point there in this kind of if the greed kicks in thing about raping the company for cash. Lots of people want to charge like a deal fee on completion, so they borrow a bit more money than perhaps the business needs, and they take some of it out. And I think that kind of comes from the property space, where it's quite common to buy a property, add some value, and then re-leverage and take some cash out for yourself. The problem with a business is if you over leverage and take cash out for yourself, and then the business gets into trouble, there's a very high possibility you get disqualified as a director, as well as them coming after you for the cash plus interest that you took out. And that's a pretty big risk to take, to be barred from being a director for say 15 years or the next 15 years. And so I do know there are other trainers who talk about taking this deal fee, but the only reason they talk about that is because they have no experience of actually being in business in this way, or they have experience of selling courses, but they don't have experience of actually doing deals. And that's just a big no-no. You should not borrow money and take it out of the business you will get in so much trouble if it all goes wrong. And of course, you don't know what's around the corner. If there is a pandemic or something that forces you into an insolvency, then you can find yourself really facing the music. It's basically fraud, so it can be really really bad. Is the course online? Yeah, so when you do the Harbour Club, basically we send you a pre-course which you can complete in your own time. When the pre-course is completed, you come along and do a 3-day immersive, intensive online thing, which has a lot of Q&A with me throughout the whole process. After that, there's a 12-week accountability follow-up where every week you're in a sort of mentoring group with an experienced person like Paul, helping you get started and go through the whole thing. You obviously have access to the community as well during that whole time, and indeed after that there's loads of groups within the Harbour Club that you can join up to as well, which are either regional or subject specific or gender specific, because there's a women's club. So there's loads of different clubs that you can then join within the community that you can use to help you. We then have live events. So when you become a member, you get access to one live event for free. The next one coming up, there's one in April, one in July, called Deal Fest, which is a 3-day, 200 to 300 people event with loads of case studies and loads of networking opportunities with other Harbour clubbers. So yeah, lots of things. We have a wealth circle where we talk about investments that we're doing and things that we're doing in that space. So there's a lot of and all of these are non-chargeable. There's no other fees that you ever have to pay in the Harbour Club. Once you remember. That's it. There's no upsells or anything like that. So yes is the answer. And the bonus course that we're talking about, the one that you'll get if you join before March the 9th, is also an online delivery as well. I'm well qualified academically, MBA, ME, NTR, DBA. What a breath of fresh air to see so much common sense in a presentation. No, thank you. Yeah, we try and focus on minimum bullshit where we can. Is it possible to leverage against intangible assets? Only in the way that we've talked about. So, cash flow finance, invoice finance, those kind of things normally exist inside businesses that have predominantly intangible assets. I joined the Harbour Club last week and I'm attending this month. Will I get the training? Yeah, absolutely. Just hit up John and I'm sure we can arrange that. Can you provide details of the finance company for the purchase order finance? Yep, if you go into the app in the Rolodex section, finance brokers in there. How do you manage businesses that you've purchased? I'll pass that one over to you, Paul. How do you manage the businesses that you've purchased?
Yeah, so I think when I was in M&A before I came to the Harbour Club, and I used to feel that I had to run the business if I was involved in it. And I think that one of the things that the Harbour Club did for me was change my perception that actually you don't need to be there to run it. And if you can free yourself of your time, you can go off and do lots more deals. So I've built a really great team of people that basically go into the businesses that we buy, and they set the strategy and they run it, and they just send me a report at the end of each week with what's going well, what's not going well, and we'll talk about real major problems if there are any, but most of the time there isn't. So it frees my time to do what I like doing, which is basically doing deals.
Yeah, fantastic. Yeah, and look, I'm a big believer in leaving the people in charge of the business. So the strategy that I tend to adopt is direct listing or agglomeration strategies. And with both of those, it's very much empowering the existing management team for them to remain in complete control of the business. So again, I don't get my hands dirty. That allows me free to keep traveling the world and doing all the things that I enjoy doing, because lifestyle is quite an important part of being a happy entrepreneur, I think. If you're bogged down in the business day to day all the time, can be a pretty soul destroying thing. I've done that. I did that for 20 years, so I can do something else for the next 20 years. So that was the choice. We've only got 2 minutes left before the hard stop, and I am aware there's a whole bunch of questions. We will save the questions and potentially do something with them at a later date. But if you have any further questions, do reach out to john@harbourclubevents.com. or Monty at harbourclubusa.com, and they'll be happy to answer any of your questions and also talk to you about this time-limited offer to join the Harbour Club. We will just go through the last couple of questions and then we'll have to go, I'm afraid. Lots of RLS lenders require you to own the business for more than 12 months before considering a loan. Yeah, the way I think Paul is talking about it is actually getting the existing owner to draw down the RLS. You then take over and they withdraw the funds. Is that right, Paul?
Yeah, that's the easiest way to do it. You can do it as a buyer coming in, but you would normally have to put in an equity check yourself. So normally it's 15%. And so as long as you're prepared to put the cash in, you can do it yourself. But if not, then yeah, it's better to just organize it with the seller.
Yeah, yeah. And is an LBO or any low cash upfront deal predicated on the owner having no other options to sell? No, often we're in competitive situations. But let me point this out: is that it's a buyer's market. There aren't many buyers out there, and there certainly aren't any that are standing there with their checkbook ready to write the asking price down in the box next to the dollar sign. So you will not, you will be surprised. Of course, everyone you speak to has got a fucking queue of buyers going out the door and that they can sell it tomorrow in a heartbeat. They're all talking shit. You know the old sales expression, buyers are liars. Well, sellers are fucking liars too. So they don't have. Paul, would you concur?
I mean, I guess just to sum that up in a nutshell as well, the biggest LBO that happened last year was the ISA brothers that bought Asda, and most of it was leverage, £6.8 billion deal, built on leverage. So,
yeah, absolutely. What a great way to finish finish up buyers are liars, sellers. I wouldn't call them scum, but they're just liars. But there we go. So thank you so much for taking the time out, and really appreciate all the questions. And I hope you got something from this and you found it valuable. And thank you, Paul, for taking your own time to come and be here. Don't forget to reach out to our team and get this special introductory bonus for signing up before March the 9th at midnight. Once it's done, it's gone. We're never going to publish that video again. So it will be buried deep in the archives. So yeah, please do reach out, and look forward to welcoming you to the Harbour Club and seeing you at one of our events. So thank you, everyone, and good evening.